Welcome back to The Explainer. I am beyond excited to be your expert tutor today. So, if you're gearing up for your exams, you already know that ethics isn't just some tiny throwaway section of the syllabus. It is literally the bedrock of everything you do. Today, we're going to completely master the South African Institute of Chartered Accountants Code of Professional Conduct. Specifically, we're diving deep into parts 1, 2, and 3. Think of this code as your ultimate ethical compass. It's really not just about memorizing a bunch of dry rules. It's about understanding exactly how to navigate complex real-world dilemmas when you're under pressure in your exams and, of course, in your future career. We are going to unpack the key definitions, apply them directly to exam scenarios, and build a totally unbreakable framework. Okay, let's take a quick look at our roadmap. We are covering the fundamental principles, the conceptual framework, the 5 threats, effective safeguards, and finally, how all of this theory actually applies to accountants in business and accountants in public practice. Let's get to it. We are kicking things off with Section 1, the 5 fundamental ethical principles. This is your true north. 5, I want you to literally burn this number into your memory for your exams. There are exactly 5 core principles, and every single ethical case study you face has to be tested against these 5 pillars. Let's break them down one by one so you know exactly how to spot a breach when you see one. First up is integrity. This simply means being completely straightforward and honest. But here's the catch for your exams. It doesn't just mean you shouldn't lie. It explicitly means you cannot associate yourself with information that is materially false or misleading. Think back to that SAS Pro sales system scenario from your notes. If an accountant manipulates that system or, say, intimidates a young employee into inflating sales and revenue streams, well, that's not just a minor slip-up. That is a direct, deliberate breach of integrity. Fraudulent inflation of revenue completely shatters this principle. Next is objectivity. You have got to protect your professional judgment from 3 specific pitfalls: bias, conflict of interest, and undue influence. Whether your judgment is being clouded by a personal bias, a glaring conflict of interest, or heavy pressure from corporate leadership, you must remain totally impartial. If a financial incentive, like a massive bonus, is making you view a really aggressive accounting treatment favorably, your objectivity is severely compromised. Okay, professional competence and due care. For exam purposes, you really need to split this into 2 distinct halves. First, attaining and maintaining your professional knowledge and skill, and second, acting diligently in accordance with applicable technical and professional standards. Let's go right back to that inflated sales figure scenario. If an accountant is fraudulently inflating sales, sure, they lack integrity, but they are also failing entirely to provide competent professional service under the technical standards. Competence isn't just passing your board exams, it's practically applying the right standards diligently every single day. Right, moving on to confidentiality. You must respect the information you acquire during your professional relationships. You absolutely cannot disclose it without proper authority, and you definitely can't use it for personal advantage. You remember the Newtel scenario from the notes, right? An audit manager actually used confidential client information to gain a personal advantage and even used it to help out his buddies. That is a massive textbook breach. And remember, you have to maintain this confidentiality even in relaxed social environments. The only time you're allowed to disclose information is if you have specific authority or a strict legal duty to do so. Our final pillar is professional behavior. You must comply with all relevant laws and regulations and totally avoid any conduct that you know, or honestly should know, might discredit the profession. Whether you work in commerce or public practice, your actions reflect on the entire CASA profession. You are essentially held to a categorical imperative. It's an objective moral law you just can't bend. All right, Section 2, the conceptual framework steps. Now that we know our fundamental principles, we need a reliable methodology to correct our course when things go wrong. You absolutely must memorize this mandatory 3-step process to unpack any ethical dilemma they throw at you in a case study. Step 1, identify the threats to compliance with the principles. Step 2, evaluate the significance of those threats. You have to ask, are they at an acceptable level? Now, what is an acceptable level? For the exam, it's defined as a level at which a reasonable and informed third party would likely conclude that your compliance with the principles is not compromised. And step 3, address the threats by eliminating them or reducing them to that acceptable level using safeguards. Let's take a closer look at those specific threats you'll be identifying in step 1. Section 3, the 5 threats to compliance. These are the obstacles actively trying to knock your ethical compass off true north. There are exactly 5 categories of threats you need to scan for. A self-interest threat is when financial or other interests influence your judgment. A self-review threat happens when you have to evaluate your own previous work. An advocacy threat is when you promote a client's position so much that you lose your objectivity. Then we have the familiarity threat. Just look at the auditor's for life scenario. A senior partner literally told the client, "We are your friends." That immediately screams familiarity threat. Plus, there was a close family relationship between that senior partner and the client's financial director, a massive red flag. Finally, an intimidation threat occurs when you're deterred from acting objectively because of actual or perceived pressures, like your boss threatening to fire you. Section 4. Implementing effective safeguards. Once we evaluate a threat as significant, we pull out our toolkit to address it. Think of safeguards as your firewalls. They generally fall into two camps: safeguards created by the profession or legislation, and those built directly into your work environment. Within the work environment, you can use tools like assigning an independent reviewer, someone totally separate from the original work. If you spot a conflict of interest, you segregate your teams and build a strict information wall. Facing a competence threat, bring in specialized outside experts. But write this down. If a threat simply cannot be reduced to an acceptable level using these tools, your only option, your absolute last resort, is to decline or end the specific professional engagement entirely. No exceptions. Okay, so with our framework firmly built, let's look at the two distinct battlegrounds you are going to face. Part 2 of the code applies to those in commerce, accountants working inside an organization. Part 3 applies to those in public practice, your independent auditors and consultants. We're going to tackle Part 2 first. Section 5, Accountants in Business. Let's look at the ethical terrain for CASAs working inside organizations. This wakes you up to the harsh reality of commerce. Think of Mr. Rabata from your tutorial notes. He's the SAICA in commerce, which means he's strictly subject to parts 1 and 2 of the CPC. But he allowed his boss to pressure him into dishonest reporting. By caving in, he directly breached the principle of integrity because he wasn't straightforward and honest, and he breached objectivity by letting undue influence completely compromise his judgment. You absolutely cannot let pressure result in a breach of the fundamental principles. So what should he have done? The safeguard Mr. Rabata should have deployed was to immediately consult with those charged with governance inside the company, or frankly, go seek independent legal advice. Understanding technology and laws is also critically vital for accountants in business. Take the Sunset cyber risk case. If Sunset doesn't have proper firewalls and intrusion detection systems, and the accountant lacks the expertise to manage that IT risk, it actually threatens the company's going concern. It's the same thing with Mills Popia and FICA issues. If you ignore hacking risks or know your customer laws, the company faces massive fines. For an accountant in business, ignoring these issues, which is known as no-CLAR, or non-compliance with laws and regulations, means you are deliberately turning a blind eye to illegal acts. That is an immediate, catastrophic failure of your professional competence and due care, and it often results in financial statements being prepared on a totally incorrect going concern basis. Section 6, Accountants in Public Practice. Let's shift gears to Part 3, where accountants are providing external, independent services. Listen up, because this is a total classic exam trap. Holding client assets creates massive, undeniable self-interest and objectivity threats. The rules here are incredibly strict. To mitigate these threats, you have to open separate bank accounts and keep client funds entirely 100% distinct from your firm's funds. Here's a great safeguard. If you find yourself holding monies for an unusually long period, you must request the client to open a separate bank account and provide you with signatory rights. This ensures total transparency. And it goes without saying, you can never, ever use those client assets for your own personal advantage. Another massive Part 3 issue is conflicts of interest. Remember the Rocky Road and Zoltan Inc. scenario? Those two are actively in a court case against each other. If your firm currently audits Zoltan and then starts developing a professional relationship with Rocky Road, Zoltan is going to be furious. It creates a gigantic threat to both objectivity and confidentiality. To properly address this, you have to obtain explicit consent from both clients acknowledging the conflict. Plus, you have to ensure that entirely separate teams are used for each client, walled off both physically and electronically to fiercely protect confidentiality. And that brings us to the end. You now have the complete picture, from the 5 fundamental principles of Part 1 all the way to navigating toxic corporate pressure in Part 2 and managing independent client risks in Part 3. My final challenge to you is this: internalize these rules, not just so you can ace your exams, but because they are the unbreakable foundation of your entire future professional career. Because out there in the real world, your ethical compass is literally the most valuable asset you have. Keep studying hard, trust the framework, and I will see you in the next explainer.